What's up, guys? So the purpose of this video today is to talk about the hourly trigger and how we can use that to better our trading. So I'm just going to jump right into it. You can see here on this chart actually 4 triggers: the monthly trigger, the weekly trigger, the daily trigger, and the hourly trigger. For this video, we're just going to focus on the hourly trigger. And I'd like to show you guys how well you could have done simply trading whether shares or options just above and below the hourly trigger. So let's zoom in on this part for now, and we'll take a look at the rest of the chart soon. So you can see here, price sold below the hourly trigger at about $37 and never poked its head above the hourly trigger until right here, which is at $31. So, right off the bat, if you were trying to add to your share position by trading in and out of the hourly trigger, so which means you sell below and you buy back above, you would have saved yourself from getting caught in this price landslide right here. Maybe you would have got caught right here by going long at the break of the hourly trigger at about $30, and you would have ended up getting stopped out at 30.44 on the breakdown below. So maybe this isn't the most convenient thing. I will explain in a teeny bit why you may not have even bought on this break above. But for now, you can see that price basically broke the hourly trigger at 37 and came down all the way to $20. So simply by using the hourly trigger as your level, you would have been out at 37 and you would have had no real reason to enter all the way until $20 or so, or $24 on this break back above. So you're probably thinking, really cool stuff, but why is this different than any EMA, SMA? How is this different than the 21 EMA or the 9 EMA? So I'll explain. So with EMAs, you have an average of the previous prices added together. So whether that's a 10-day rolling period or a 21-day rolling period, and it's basically smoothing out the averages of the price, taking out these spikes that you see on a price chart, and just giving you the average of the price range over the past 10 days. The difference between the hourly trigger and a EMA or SMA is the hourly trigger comes with hourly velocity. So this is hourly velocity, and velocity can basically tell you the strength of a move. And so if you would ask somebody, what's the most important thing to track when trading a stock? A lot of people will say technical analysis, chart patterns like cup and handles, bull flags, bear flags, pennants. Maybe some people tell you volume, some people tell you the volume shelf, the point of control, the area where the largest amount of shares were bought and sold. Some people tell you EMAs, some people tell you Ichimoku clouds, some people tell you Bollinger Bands. From what I've seen in my experience trading, velocity is actually maybe the single most important thing when it comes to trading stocks. And so velocity really just tells you the strength of the move, the strength of how a stock is moving. When there's low velocity, when there's high velocity, velocity is very telling. And what's really cool about the hourly trigger, and I'll show you more examples of this soon. In fact, right after this, I'm going to jump over to the day trader chart to show specific examples. But when hourly velocity is strong, so let's say over here you have a print of -1.5, that's pretty strong. You have -2 here. You have -2.3 here, that's pretty strong. When hourly velocity is strong, price will almost never break through a trigger. And so with the EMA or SMA or any moving average, you never know if price will fall below or break above that EMA. But with the hourly trigger, by looking at the hourly velocity, you know immediately if price can make it through the hourly trigger or not. And so it sets up really good examples if price is above the hourly trigger. So let's move over right here to the day trader chart. So here we have price above the hourly trigger. This is an example from the trading range of September 14 to through the end of September 19th. And you can see we had one bounce here. You could call this another bounce here, 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 here as well, and here, and here, and here before finally lifting off. Now, if I take away the 1 minute trigger and the 5 minute trigger and just render the hourly velocity, you can see the hourly velocity over here was positive 0.009, which isn't even that impressive. But look what happened when price went to the hourly trigger with positive velocity. Caused a nice sharp move right back up. Now over here, we're working with 0.06. This is some pretty good velocity. And so when price came down, it didn't even get to the hourly trigger before bouncing up again. And so when trading using the hourly trigger, when you have positive hourly velocity and price comes down to test the hourly trigger, that's an automatic dip buy. And you can always have a stop loss right below the hourly trigger, you know, in case it's one of the 1 out of 10 times where where the hourly trigger won't hold as support. But with statistics and back testing on your side, you can almost be assured that every time you have solid hourly velocity, when price comes down to test the hourly trigger, it's going to bounce. So we had that right here. And then over here again, we had really good hourly velocity. And here we had decent sized hourly velocity. Price came down to the hourly trigger, broke right above. Over here, this was actually when CPI data came out. So price gapped down really strong. The market SPY sold from 413 to 400, you know, almost in pre-market. And yet, because we had positive hourly velocity the day before, and we were coming into September 16 with positive velocity, when price came down to the hourly trigger, it couldn't break below. Because with positive hourly velocity, the hourly trigger is going to act as support. And so when the market opened on September 16, maybe some people were selling, but we knew by using the hourly velocity from the previous day that the hourly trigger is going to hold for us, and it provided a really nice bounce here. Over here, price came down to the hourly trigger again. Now we didn't have a lot of hourly velocity. You can see that this 0.06 hourly velocity, that's the smallest bar that we had this whole time. So we had a little bit of a scare with price coming down the hourly trigger, but still popped right back below. And you know, the negative print was also very measly. It was only a 0.006. So now these kind of prints are very negligible. And if you've noticed, GME has actually been trading with extremely low volume the past 5 days. So it could be this isn't the best time to bring examples for a velocity terminal. But nevertheless, we got this nice bounce off the hourly trigger, continued up. Over here, we had hourly velocity 0.02, which is a lot higher than 0.006. Price came down to the hourly trigger, bounced right off it. Then we had this really nice run on September 19th. We had an hourly velocity reading of 0.08, which is the highest velocity reading that we had in this trading range, in this 5-day trading range. And so because we knew we had positive hourly velocity on our side, when price came down to the hourly trigger, we got this nice little bounce right here. And then bounce again right here, bounce again right here, bounce again right here, before finally lifting up. Now, you can try to use any other EMA or SMA to mirror this, but you can see that when price bounced right here and right here and right here, you know, it didn't bounce where my mouse is, where my cursor is, down at 28.05 or down at 28.10 or 27.90. It bounced exactly off the hourly trigger. The hourly trigger is calculated exactly where it's supposed to be, and it's extremely precise. And so maybe sometimes they'll have price sell a little under on really strong selling moves. But in general, you know, the hourly trigger is going to be a pretty precise bounce point. So these are some examples of price bouncing off the hourly trigger with positive hourly velocity. This is the day trader chart. And now let's hop back over to the 6-month chart. So this was, you know, we had so I was showing you guys the velocity readings back here where, you know, 0.06, 0.08 was the highest reading we had in this entire 5-day trading range. When I go back here, and we're taking a look right now at the month of April all the way through almost half the month of May, you can see the stock was moving with a whole lot more velocity. Here we're getting readings of 0.1, negative 0.1, negative 0.15. Here we get negative 0.2. Here we get negative 0.23. So GME was moving with a whole lot more velocity here. And the stronger the velocity is, whether it's to the upside or the downside, that's how strong the move is going to be. You could see the negative readings were really strong to the downside. Negative 1.3, negative 1.5. So that showed us that this move down was going to be really, really strong. So as soon as we had this negative selling pressure right here, we sold under the hourly trigger, and we started getting readings of -1, -104, -13, -15. Right away, we were able to see, okay, the nature of this move is one that's strong in negative velocity, and so the selling is going to go on for a while. And sure enough, we ended up selling pretty much from April 21st. So this is about 20 days almost of straight selling. And these bars we call capitulation bars. So when velocity gets like extreme, like here we have -3, here we have -3.2, here we have -3, that's usually like the end of the move. It's not that when velocity gets really, really strong, it means now we're about to sell to zero. No. When velocity gets really, really strong to the downside and just, completely dwarfs the other bars, that usually marks the capitulation point and the turning point low. So here we have that to the downside. And now let's take a look at this move to the upside. And let's examine it. So immediately we break above the hourly trigger over here, and we can see that the stock makes a really nice move up. Like I was showing you before with capitulation velocity bars, here we have a 0.8, which I believe is the highest GME reading since possibly January 2021. I would have to back check that information, but 0.8 is really extremely high for GME. And so this was a capitulation bar, and sure enough, we started selling down. But look how the hourly trigger here provided a really nice bounce right off the hourly trigger because of all this positive hourly velocity we're coming off. And then over here, notice when we sold below the hourly trigger. We sold below when velocity was 0.01, which, let's jump back here, 0.04, 0.06, 0.06, 0.03, 0.04. So, when velocity is as low as 0.01, right, at that point, we're not necessarily expecting the hourly trigger to hold as support. When are we expecting the hourly trigger to hold as support? When we have velocity readings like 0.3 and 0.31 and 0.16. Whenever you get readings like this, you're almost guaranteed more than 9 out of 10 times that the hourly trigger will hold as support. When the hourly velocity is extremely low, like a 0.1, that's where we're not necessarily expecting the hourly trigger to provide support. And so we sold under, but we didn't generate any strong velocity readings to the downside. We were able to pop back above. Now here we have a 0.2 reading, and here we have a 0.16. And so what does that tell me? That tells me, okay, since we have good hourly velocity, if price would sell back down to the hourly trigger, I want to buy that dip. I don't want to sell. That's where I want to buy, because I know with good hourly velocity, the hourly trigger is going to act as a support level. And so price sells down to the hourly trigger. Sure enough, bounces right off. Here, holds the hourly trigger this entire period before lifting back up. And this is when over here we sell through the hourly trigger with 0.04 hourly velocity, and that's when the move to the downside starts. So while we're here, I like to bring out something called divergence, which is when price makes a new high but velocity doesn't. And when you have that, that's a bearish scenario. Now, you really need 3 sets of divergences, so 3 new highs while velocity is not making new highs to confirm a bearish divergence. But sometimes even after 1 or 2 new highs, price will snap back down to that trigger. So over here you can see we made a high of 36.11 with an hourly print of 0.8. And when we made a new high here of 36.62 and then another high of 36.9, but velocity was not as high as it was here, most of the time price will come back down to the hourly trigger. And here it came back down and sold through with an hourly print of 0.04, which doesn't tell us that the hourly trigger will hold as support, and so no surprises here. Then you can see, we put in a low here of 31.78, and the negative reading was -1.2, and then when we made a new low, the negative reading was -2. So no divergences there, nothing out of the ordinary. This is normal selling pressure. So by now you're probably getting the idea of, hourly trigger and hourly velocity. We could also take a look down here at this, because here we're going to see a beautiful example of bullish divergence that led us to believe that the bottom was in right here. So the rule is whenever you have 3 divergences, price will go back to that trigger, whether it's 1-minute divergences, 5-minute divergences, and I'm going to show you an example of 5-minute divergences right after this. But let's take a look here. So first we look for the most extreme velocity reading to the downside, which is right here at a price of 34.9, and the extreme reading to the downside was -3.2. Now, if price puts in 3 new lows, and none of those lows have an hourly velocity reading of -3.2, that's when we have bullish divergence, and we can expect price to snap back to the hourly trigger. So again, each of these is not a new low. It goes in sort of like Elliott wave terms. So like a new low, and then let's say like a retracement, and then a new low, and then a retracement, and then a new low. So here's the most extreme reading at 34.90, and then we put in a new low right here at 30.78, and if you'll notice, the hourly velocity bar is -1.8, which is less negative than this -0.32. And so this would be considered our first divergence. Now we have a little retracement up, and you can see even with 1 divergence, price already wanted to attack this hourly trigger, but it wasn't able to break through. Then we sell down to 27.13, and you'll notice again, this hourly velocity bar was not as extreme to the downside as here. And so this is 2 bullish divergences. And as you can see again, after 2 divergences, price wanted to attack the hourly trigger, but it wasn't ready to get all the way there. Then price makes a 3rd low. And the 3rd low came in at 23.84, and you'll notice that this hourly velocity bar was not as extreme to the downside as this one. And so this time, price snapped back to the hourly trigger, but after a little bit of hanging around, it was able to pop above. And then, ever since then, we've just been drifting around. So I'm going to give you a quick example now of 5-minute divergence, so you just understand how this works. So you see how price, made its first high right here, and then we could say that, well, it's arguable how you want to define this, but I would say this is the first high of the move, 29.17. Then maybe we'll say 29.40 was the second high, and then any of these 3 we'll call it the 3rd high. So let's look at the 5-minute velocity, and let's zoom in. And I'll also bring in the 5-minute trigger. So again, our first high came right here at 29.17, and I'm going to remove the hourly trigger to make this more clear. 29.17, and the velocity reading was 0.02. Okay, but the highest 5-minute velocity reading was right here, which was 29.40, and the velocity reading was 0.05. So I'm going to take away the mouse for a second. Now, from what I just a little frozen for a second. From what I showed you before with hourly velocity, any new high after this 5-minute print that doesn't make a print as high as this one, which is a 0.056, is called 1 bearish divergence. And so if we count, let's say this new high at 29.49, you can see this 5-minute print was 0.03. That's clearly 1 bearish divergence. Over here, we make a new high, 29.54, with your second bearish divergence. And over here, when we make a third high, 29.55, the 5-minute velocity was 0.01, which is way less than 0.056. And so you have your high right here, you have 1 bearish divergence, 2 bearish divergence, 3 bearish divergence, and price sells down. So in short, that's how we use the hourly trigger to trade in and out of positions. And that's how we use velocity to measure how strong the hourly trigger will provide support or resistance. And that's how one can trade in and out of a position based on the hourly trigger. Now, if you look at the GME chart, you'll see that there was multiple times, for example, this landslide, where you could have saved yourself a lot of money from selling under the hourly trigger as soon as the hourly velocity came extreme to the downside and bought back in at a much cheaper price. Or if you wanted to protect yourself and maybe buy protective puts or sell covered calls, or just wait till price, or if you're just a buy and hold, you could wait for price to pop back above the hourly trigger to buy more shares, as opposed to just buying all the way here on the way down. And then we can also see another beautiful example over here, where price sold from 41 all the way to 23 without once popping above the hourly trigger. So using the hourly trigger and hourly velocity is a great tool for protecting yourself. And doing better in your trading. So that's all for this video. Remember, triggers act as an acceleration level. So a lot of times when you break above a trigger, it'll make price move faster in either direction. When breaking above the hourly trigger, you can expect price to move faster to the upside, and when breaking below the hourly trigger, you can expect price to move faster to the downside. In future videos, we'll talk about the 1 minute trigger, the 5 minute trigger a bit more, and we could get into the daily trigger, the weekly trigger, the monthly trigger, the daily velocity, the weekly velocity, and the monthly velocity. That's all for now.